Hey, what's going on, traders? Bennett Tyndall with TradingAnalysis.com. Hey, I'd like to welcome you to our YouTube channel. Just thought I'd bring you guys a bit of a market update. So today is Thursday, March 17th, 2020, and the market volatility continues. If you've been following our public blogs, I usually post anywhere from 1 to 2 times a week. You'll know that we've been highlighting the fact that this, although having been compared to some of our previous outbreaks, I've seen a lot of analysts and traders comparing the coronavirus to that of influenza or perhaps SARS. The difference is regardless of the health impacts, right? Regardless of the mortality rate, whatever it ends up being once we see this, the number of cases actually begin to peak, we're still going to have an economic impact. And that's something that we've been highlighting with our members. That's something we've been talking about. Right now, the market is moving on a lot of fear. So there's a lot of fear that's driving sentiment currently. And really, it's kind of the fear of the unknown, right? We can't quantify what the bottom line impact is going to be, not only on individual companies' earnings, global GDP, but now, of course, unemployment. I was just walking through the top 10 occupations in the United States with our members yesterday. And you'd be amazed at the number of industry groups that are seeing a consolidation in workforce. I mean, heck, if you take a look at restaurant reservations, they're down anywhere from 50 to 70%, depending on where across the United States they are. So things are certainly escalating. And although I don't see this as the start to a 5 to 10 year bear market like some are predicting, I do see this as a very significant correction. It's something that the market has been very vocal about, I guess you could say, given the magnitude of the decline that we've seen. So we've seen a lot of capitulation. We've seen a lot of fear selling taking place. Again, we just can't quantify what the bottom line impact. When you compare SARS to the coronavirus or influenza to the coronavirus, regardless of the health impacts, when you have the disruption to supply chains, when you see companies closing down factories overseas, when you see you see states enacting curfews, you see a kind of this escalation of isolation within the United States. You're seeing a lot of states that are going to 50 people or more. Any events that take place with 50 people or more are now kind of banned, I guess. So it's something that we'll continue to kind of understand as it unfolds. And I think the market is just very uncertain about where this is going to end up taking us. And until we see kind of a peak or a plateau in the number of cases within the United States, I think we're going to continue to see this fear within the market. So let's go ahead and dive into it, guys. We're going to dive into the Motivate platform here. Just to give you a heads up, we do have some upcoming events. Of course, tomorrow is our Elliott Wave Wednesday live stream, 8:45 Eastern on Todd Gordon's YouTube channel, and we do have a special guest lined up. So I hope to see you guys there. And then we have a Thursday webinar. So if you guys have been interested in purchasing Motivate, but you haven't yet, maybe due to the cost, I talked about this a little bit in the video ad. We're kind of piggybacking a webinar along with MotiveWave's annual spring sale. So you might not know this, but we have our own trading analysis specific version of the MotiveWave software, and that will also be available at the discounted price. So we're putting on a webinar this Thursday. That's going to be the 19th from 4 p.m. Eastern till about 4:30, 4:45. So 4 p.m. Eastern, 4 p.m. Pacific, 7 p.m. Eastern is the start time, and you can expect to be there about 30 to 45 minutes. We're going to take you through all of the really key features that we find absolutely invaluable to what we do here at Trading Analysis on a daily basis, and of course we'll provide you with the sign-up link. So let's jump into it, guys. Let's take a look at some technicals. Enough talking. Let's see what the charts have to say. So let's start it out here. Actually, I'm going to bring over, let's take a look at gold, oil, the dollar, kind of like we would normally do on one of our standard video updates. So as you can see, if you've been following along with my public blog posts, we've been tracking this decline here in crude oil from the 65 handle. We counted a nice 5-wave motive impulsive decline. This 5-wave decline ended up coming to completion in the form of a wave 5 ending diagonal. We then have a move up in A, an extended B wave, where you can see this nice discernible 3-wave subdivision. And from there, we put in a little C wave back to essentially the area of the previous fourth. So we didn't get a typical 50 or 61% retracement out of that wave 2, but we did see resistance into the area of the previous fourth, and we also had equality of the corrective leg. So if you look at corrective leg C versus A, you can see equality came into play. We ran into that wave 4 resistance, started to move lower. So from there, I see this as down in 1, up in 2, nice 50% retracement in this wave 2. And this is this beautiful third wave decline where we have this nice acceleration gap. We put in a wave 4 that took us to about a 50% overall retracement of the wave 3 decline. And now I see this as the makings of wave 5 of orange 3 here. So we do have some pretty key support offered from a variety of degrees of trend, multiple degrees of trend between 26 and 28.78. So this is the zone I really want to start to see crude oil start to respect, and perhaps we can get a little bit of a relief rally from there. So anticipating a orange wave 4 to square up to this orange wave 2 before completing the overall 5-wave decline. So I don't think we're out of the woods just yet in crude. We'll continue to monitor this chart and we'll be sure to keep you guys updated. Over to the dollar, we've been tracking here on the weekly chart. Let's go ahead and start it out, taking you all the way back to the 2008 credit crisis low here, up in 1, ABC down in 2, another 1, 2, 3, 4. Notice within this wave 3, it's a beautiful 1618 extension of wave 1. We have equality of wave 4 and 2. Wave 4 was also a nice 38% retracement. That gives us a higher degree wave 3, just shy of that 1618. Absolutely love it. And from there, let's go ahead and get you off the weekly, get you down to a daily time frame. So from 2017, we can count a nice 5-wave decline in the dollar, and we have this 5-wave rally in green A, some sort of a complex B wave that's continuing to hold support. We're getting this rally here in C of B. Overall resistance is that 100.25 to 100.3 area. So I'll be keeping my eyes on this, but overall not seeing any clear directional changes as of yet out of the dollar, and it's certainly something we're continuing to monitor from a macro standpoint. Over to gold. As you guys know, we've been tracking this with you together. So out of orange 4, we were looking for this move to between 1600 and 1650. Once the wave 3 top came in, we had a beautiful 3-wave retracement here in 4. After the 1554 wave 4 support, which happened to be a 38% retracement of that wave 3, we put in another rally. Things get a little bit confusing from an Elliott wave perspective on a smaller time frame. When looking at this correction here, it's a little bit unusual, this 3-wave decline and rally back, which has ultimately led to even more downside. And although we are still tracking this possibility that in fact that was all of a 5-wave advance within C of that higher degree B wave, and we are pushing back into this trend channel, we are also entertaining a bullish alternate, which we're going to discuss here in just a minute. So let's actually just jump right over to it. And the bullish alternate actually suggests that we're going to go all the way back to a 1-month chart here. We're going to kind of try to put things into perspective, taking you back to 1976. So going back to 1976 in gold, you can see this nice 5-wave rally, prolonged wave 2 or B to a 61% retracement. And now we're wondering if this is simply 1, 2, 3, and 4 of the higher degree wave 3. Higher degree wave 3 equality to wave 1 comes in at 2182. Taking you off the 1 month, let's get down to a 1-week chart. And essentially, as opposed to this being a 5-wave decline, which I think it counts better as a 5-wave decline, we would be looking at that as simply a complex overall complete correction. That would then put this as a wave 1, 3-wave retracement in wave 2, and this is a nice 5-wave move to make up wave 1 of a higher degree wave 3. Now, although wave count invalidation technically doesn't come until we break through the origin of that wave 1, I think we need to see support between 1350 and 1400. If 1350 to 1400 can hold this zone and we start to see some sort of a response from that area of support, then perhaps we could look for continued upside. So getting you down to a 195, I can see a nice 5-wave decline, perhaps a little 3-wave retracement here in a B wave, looking for resistance between 1540 and 1575. If that resolves into a nice 5-wave move here in C into the wave 2 support, then perhaps we'll continue to look at this possible alternate interpretation, which suggests we do have additional upside in gold. All right, guys, over to dollar yen really quick, and then we'll jump over to the most important stuff. That is the S&P 500. So we did count a possible 5-wave decline and 3-wave retracement back here. From a longer term standpoint, we are still tracking a couple of possibilities. So I don't really want to go into this in too great of detail. I think we'll hold off on this and wait until we have some additional clarity there. But until we really see a true break of this range that we continue to exist in, I wouldn't get too excited in the Forex space. All right, guys. Let's go ahead and jump over now to, of course, the S&P 500. So let's start it off, and we'll talk just briefly about our two primary wave counts that we are tracking in both the S&P as well as the NASDAQ. Now, the Dow Jones Industrial and the Russell 2000 Small Cap, both of those violated the December of 2018 lows, which invalidates any triangulation potential within those particular indexes. Looking at the S&P 500 and the NASDAQ, we still technically have the triangle count as a possibility, but given the magnitude of the decline off the highs, it's becoming quite likely that in fact this is an impulsive 5-wave decline, perhaps of that wave 4 flat. So let's talk about it really quickly. This has been our count at Trading Analysis going back to around November of 2018. Once this 5-wave move in C came to completion, we started to put some capital to work in our portfolios back to the upside. And currently, let me just take you out to the weekly chart. All right, this becomes a little more clear. Let me go ahead and just get rid of this trend channel. So going back to the credit crisis lows here in March of 2009, we can count our initial 5-wave rally. This is where the wave 2 flat comes into play. We would not look at this as 1-2, smaller degree 1-2, because that would be a clear degree violation. Elliott wave is fractal in nature. You're going to see smaller trends make up a higher degree counterpart wave. So you wouldn't see a minor degree second wave that has a larger net percent retracement than an intermediate or a primary or a cycle degree wave 2 correction. I hope that makes sense. So if this were to be cycle 1-2 and primary 1-2, primary 1-2 would be such a larger net percent retracement that it would give us not only a disproportional look, but it would be, of course, a violation of one of the key Elliott wave rules. So from there, this 5-wave rally here in green, cycle degree wave 3, took us right to that 1618 objective at 2845. From there, we've essentially been in a series of 3-wave moves. So we've had a 3-wave move off the September 2019, September 2018 high, which was 2940, spot 91, had to move down to around 2346, spot 13. We're defending that area, right? We're continuing to hold those lows. So technically, this is valid as a 3-wave structure to complete C of that wave 4 triangle. Here's where my issue comes into play. Getting off the weekly down to the daily, notice within the move off the September 2018 high, you don't have any acceleration gaps. You can see that the wave C, it was beyond equality, but we weren't quite a 1618. And you have nice, clear subdivisions within that particular decline. And it's a pretty straightforward 3-wave structure. You can also see this 3-wave structure overall came to completion right at a 61.8% retracement, so met our typical objective there. Now, notice if I just go ahead and hide all of these degrees for you, and I'm going to take you off the daily, I'm going to get you down to a 1-hour chart. Look at these acceleration gaps that we see as the market has unfolded to the downside. Also notice the magnitude of this decline, the characteristic kind of swift nature of it. Also, we broke through what would be considered the corrective trend channel. So if we were to take that high, project it over the top of the B wave, project that parallel trend line over the bottom of the A wave, that gives us our parallel trend channel, which is a corrective Elliott trend channel. We broke through that with an acceleration gap. So that, and also we met the 1618 target. So when you take that and you take into consideration the fact that the Dow has broke through the 2018 lows, the Russell 2000 broke through the 2018 lows, we aren't expecting a peak in cases in the United States, at least based on what our president is saying, until July or August. when you take all of this together, the totality of our analysis and the circumstances and all the data we have available suggests to me that this is more characteristic of a 1-2 decline as opposed to an ABC. So this would be down in 1, up in 2. We're just now into wave 3. We're going to get a wave 4. Then we continue to push lower before we actually find a bottom in this market. We're seeing unprecedented levels of volatility. As you can see, the VIX, I mean, we're trading, gosh, last I looked, the VIX, I think we broke through the 2008 credit crisis levels. And I mean, we're trading 70 handle VIX, just absolutely incredible. So I think this fear and this fear-driven capitulation is going to continue until we have more clarity on the economic standpoint, and as well as, just kind of determining when this all might come to completion. As you know, a vaccine is still a ways out. I think being proactive in all of these shutdowns is to our benefit from a health standpoint. Obviously, it's going to have an impact on the economy. You also take into consideration the consolidation of workforces. You're seeing some layoffs within certain industry groups. Some industry groups are going to recover a portion of this revenue. Not all of them will. Those are being laid off. We're going to have an increase in unemployment. How's that going to impact consumer spending? So I don't see this as, all of a 3-wave move that's going to give us a massive D-wave recovery. So where I'm at personally and where we stand as a team at Trading Analysis is the idea that we are in fact trading this 4th wave flat. Now, this 4th wave flat essentially still has the same origin. The origin is off the September 2018 high. We have this nice 3-wave move. That's A of the flat. This is the B wave, 3 waves back in the flat, and this is just simply a 5-wave decline. Getting you off the daily down to a 1-hour chart, there's a couple of ways that we're looking at this currently. So here's your initial decline here in wave 1. Here's this 3-wave retracement, right to a 50% retracement. Then we put in another 5-wave decline here. Wave 4 gave us equality of waves C and A within that 4th wave. Wave 5 was 61.8% of the magnitude of waves 1 and 3 combined. And that was also right at that higher degree 3rd wave's 161.8% Fibonacci extension or projection. So that puts us at 2370 support level. Essentially, I see us in a sideways period of consolidation here in a wave 4, maybe out to March 23rd, as late as March 26th. But ultimately, we are looking for this to resolve into a 5th wave decline to take us into support that exists between 2,000 and 2,100 in the S&P 500, guys. So that's really the key zone of support that we're targeting. That's the key zone of support that I think will be very critical to the markets. When we get to that level, how the markets respond, it's going to be very, very interesting. Okay, so yes, could this be ABC of an overall 4th wave triangle? Yeah. From a probability standpoint, is it statistically speaking the most probable outcome and wave count? Not really. As I mentioned before, when you take into consideration the totality of all of our analysis, it all suggests that we are either in C of this 4th wave. If we just absolutely collapse and crater through 2,000, 2,100, we can explore alternate possibilities. We do have one alternate here, which is supported by several names, including Intel and Microsoft and Google. And this essentially would have completed our 3rd wave at the most recent February highs. This is still a very similar overall zone of support, right? So in this particular alternate, which I'm not proposing as our primary, it's simply a count that we are tracking as a possibility from an Elliott wave perspective. That is, this initial 5-wave decline is simply going to be A of a wave 4. We get a B wave that rallies back to the trend channel. We retest that trend channel, and then we push lower. But again, very similar support levels, just a little bit of a different path in getting there. So guys, if you're on some sort of a dollar cost averaging investment plan and you're looking to take advantage of some of these valuations and extreme lows, I would do so very cautiously. I wouldn't put all my eggs in one basket. I wouldn't put all my capital into one position. You definitely want to take little bits, nibble along the way, and wait for the markets to kind of give us some additional clarity on if in fact we're going to see this 2,000 to 2,100 area hold in the S&P. Okay, over to NASDAQ. So taking a look at the NASDAQ, guys, we see a very similar story unfolding here. We're running into a little bit of support here. You could very well look at this as B wave, A, B, C of C of this fourth wave triangle. But as I mentioned before, when you take into consideration what the Dow's doing, what the Russell 2000 is doing, what the S&P is doing, I think it's a lot more likely that we're looking at a very similar story here, and that we're working a C wave, 5-wave decline, and C of a 4th wave flat. All right, guys, I've kept you long enough. I hope you've enjoyed the presentation. Be sure to subscribe to the YouTube channel. Give it a thumbs up if you enjoy the content. Don't forget to check us out at tradinganalysis.com, and I will catch you guys on the next video update. Take care.